With our market panel after this wild week of trading, joining us now is Kevin Gordon of Charles Schwab and Jose Rasco of HSBC Private Banking and Wealth Management. Good afternoon to you both. Kevin, I'm going to start with you because we had the worst day for the S&P since 2022 this week. We had the best day for the S&P since 2022 this week. And it looks like we're finishing basically flat. We're actually up today about 0.5%, 53.44. We've done a round trip. Where do we go from here?
It's remarkable. I think that there was probably too much of an adverse or negative reaction to some of the payroll data last week. And then there's probably too much of a strong reaction, you could argue, to claims yesterday. But I think it's sort of nature of the beast when you get such a low volatile environment. You get this sort of coiled spring and a jump in volatility when you get such a strong event like we had on Sunday night. It's not surprising to see. I think that you have to sort of parse through and maybe separate what is an actual growth or recession fear and what is sort of a response to maybe more of a deleveraging or sort of the unwinding of a popular trade, that being, tech, at least in the case of the United States, tech that got so stretched in a really frothy sentiment environment versus something that looks a little bit more dangerous from a recession standpoint. I think the positive nature of what has happened over the past week is that when you look at some of the sector action and you look at even the economic data, whether it was ISM services or whether it was claims, there's not as much, I think, to speak to the fact that, the market's telling you we're going into some sort of imminent recession. You look at some of the gainers this week and what's been doing well, financials, energy, industrials, that to me doesn't signal that the market is voting or saying that a recession is sort of imminent.
It's kind of like you took the words right out of my mouth, because I'm going to say it's amazing. Week to date, the top performers: industrials, energy, communication services, and financials. And Jose, we've got a market now that is debating what the cut looks like come September, whether we get 25 basis points or 50 basis points. But it would seem everybody now expects a cut. Is there any reason not to?
The only fly in the ointment could be inflation, right? I think we're clearly going to see weaker economic growth. But the question is, does inflation slow, or could we see an upside surprise in the next month or so? And we don't think so. If you look at the numbers we're getting next week, they look relatively benign. In fact, the core rate is expected to go down further. So that's good news. And the PCE deflator, remember, Morgan, 2% symmetric rate means 1.5% to 2% kind of range for the Fed. And we're already there on the PCE deflator. It's a 2.5%. So I think they have the ammunition they need to move. The question is, as was just mentioned, has the market overdone it in terms of eases? Is 4 or 5 eases really logical in an environment where we have an economy that's slowing, but not yet all that rapidly, right? So, but yeah, we think. And the other question I would say is, once the Fed does ease, is it already in the price?
That is a key point. Kevin, you like cyclicals here? Those are the sectors you'd be investing in?
Yeah, I mean, I think with the caveat that, it's not a thought on our end that you're going to go into this economic, sort of broad expansion and reaccelerate from here. We still think that you're staring down the barrel of an economy that is softening. But when you take a bigger picture look at what's happened over the past couple of years, we've gone through weakness already in certain parts of the economy. Clearly, manufacturing and housing and consumer goods and everything cyclical, got hit first. Now that's starting to translate and transfer over into services and parts of the labor market, evidenced by the trend that we've seen even in payrolls or the unemployment rate. But our thinking is that there aren't these big imbalances or, big pockets of leverage in the economy that are going to take you down, akin to what you had seen in prior recessions. So as long as you get this sort of continued roll through in the nature of the recession that has hit the economy already, we think that you can kind of get the rollback and sort of the reverse of that in a recovery sense. So if that sort of, keeps intact and hangs in there, and the Fed embarks on what we think of still as of now is going to be a relatively easier, relatively less aggressive cutting cycle, historically that tends to benefit the cyclical parts of the market over the traditional defensives.
Okay. Jose, what do you like right now? And I ask that knowing that we haven't just seen volatility this week in equities. We've seen it in the bond market as well. So it's worth also raising the question, how much are stocks now going to take their cues from what we see in treasuries?
Well, I think you're going to continue to see that volatility in fixed income filter into the equity markets, especially as the Fed begins its easing cycle. More importantly, as Treasury continues, as Janet Yellen warned us about last year, continues to issue more debt in a lumpy fashion. And we've seen twice already where that has pushed the yield curve up, and it has resulted in volatility in equities. Now, one very important factor, though, people keep forgetting is in 2021, we've refinanced like crazy. We set an annual record for corporate debt issuance in 5 months, Morgan. More importantly, about 10% of CFOs moved from 0 to 2% in terms of their duration from 5 years and out. that is a very big deal because 10% of corporate America may miss the large part of this Fed tightening cycle that we've been through, right? Because by 2026, 5 years after 2021, Fed funds will be right back where they were. We did a full circle, and you could see a lot of companies coming to market at rates they were already at 5 years ago or very similar to, right?
Oh.
So they may have missed. That's a very positive for balance sheets, which I think helps the story that we were talking about earlier in terms of keeping the economy afloat.